Hello and welcome to my channel. In today's video, we will analyze to see if the US stock market is currently in a bubble which is about to break in the near future. As of January 2021, the valuation of the US stock market is at one of the highest points compared to its historic past. We begin our analysis by looking at the four important valuation metrics to assess the overall valuation of the US stock market. The total market capitalization to GDP ratio, also known as Buffett indicator, is one of the key metrics which measures the market capitalization of all the listed companies in comparison to the size of the GDP. A higher ratio signifies overvaluation. As of today, this ratio is at 176%, which is the highest ever in the history of the US stock market. Even prior to 2000 dot-com bubble, the ratio had reached only 159%. Thereafter, prior to the global financial crisis of 2008, this ratio had breached the 100 mark. Over the last 20 years, the US GDP has grown only at about 2% on an average. So, the biggest questionable thing is the premium that the investors are paying to buy assets of a GDP that grows only at about 2%. Thus, a high market cap to GDP ratio is one of the first indicators that highlights the fact that US stock market is in an extremely overvalued zone. Now we look at the Shiller price to earnings ratio. Shiller price to earnings ratio is a better indicator compared to the traditional one-year trailing price to earnings ratio because it uses inflation adjusted 10 years average earnings to calculate the ratio. As of today, the Shiller prices to earnings ratio is at 35, which is second only to the 2000 dot-com bubble. However, it is almost twice than its historic average and historic median. And if we apply the mean reversion theory, which says that returns of assets will revert to their long-term average, going forward either the earnings have to double or the price have to halve, or a combination of both might occur. This is the second indication of overvaluation in the market. Price to book is one of the most commonly used metric to gauge the valuation, and it gives a ratio of the total market capitalization of the stocks and net assets of all the companies on the stock market. Historically, the price to book ratio has averaged at about 2.9. However, currently the price to book ratio is 4.3, which is almost 50% higher than the average. The price to book ratio is higher than the 2008 and reaching the levels of the dot-com bubble. Currently, the price to sales ratio for the overall market is about 2.8, and it is much higher than what was seen in the bubble of 2000 and 2008. Also, it is way above the historic average. Thus, all the four valuation metrics tells us the same story, that the market is currently in a significantly overvalued zone. Now let us try to understand the cause behind this overvaluation. In 2020, due to the COVID-19 crisis, the GDP saw a contraction and economic activity had dropped significantly. In order to revive the economic growth, the US government and central banks adopted expansionary fiscal and monetary policy respectively. The government pumped more than $2.5 trillion as fiscal stimulus, and the Federal Reserve lowered the interest rate to almost 0%. Both the fiscal and monetary stimulus saw an exorbitant amount of flow of money into the financial assets. As Warren Buffett has said, interest rates are to asset prices what gravity is to Apple. So when interest rates are low, there is very low gravitational pull on the asset prices. Thus, the almost 0% interest rate resulted in the rise of the asset prices in the economy. All three asset classes, housing, bonds, and stocks, saw a sharp increase in their prices. The housing price index is at its historic high. Similarly, the bond yields are the lowest in the history, and so the bond prices are at the highest. And the effect of low interest rate is also observed in the overall rise of the stock market. But a more important question as an investor would be to understand if this is sustainable and when will this bubble burst. As long as the interest rate remains as low as 0%, observing a significant price correction in the market might take a long time. However, if inflation rises, central banks might consider raising the interest rates to contain the inflation, which would result in the price correction. For any investor, it is very difficult to precisely time the market. However, as an investor, it is important to understand the market conditions and place the bets accordingly. In such conditions of overvaluation, it is always advised to be cautious. I hope you found this video helpful. Thank you.